4% U.S. inflation, a 40-year low for the Japanese yen, and 2 new Fed advisors appointed in a single day. The Federal Reserve is preparing a policy pivot that could trigger a massive capital flight from emerging Asian markets. Fed Chair Kevin Warsh has just appointed 2 new hawkish advisors to his inner team, signaling a massive shift in direction. Markets are reading this as a clear signal that rate cuts are off the table and a hike is back. A rate hike is now officially back on the table. This policy shift is about to send shockwaves through Tokyo, Singapore, and New Delhi, resetting global investment flows. The era of cheap money is gone, and the global financial landscape is shifting rapidly. Welcome to East of Wall Street, where we connect the dots of global power and finance, helping you navigate this crisis. Why is 4% such a terrifying number for American monetary policy? In the world of modern central banking, 2% is the golden target, representing long-term price stability. For 3 years, the Federal Reserve fought a brutal campaign to push inflation back down to this level. Crossing the 4% threshold in May shattered the narrative that inflation was tamed, surprising economists globally. A psychological boundary has been crossed, and consumer expectations are rising, threatening to embed price increases permanently. This forces the central bank to choose between supporting economic growth and defending price stability. If inflation remains sticky, interest rates must stay elevated, suppressing business investments and borrowing. The threat of a wage price spiral looms over the U.S. economy, threatening to destroy middle-class purchasing power. Markets are now pricing in a higher terminal rate, altering global investment strategies and asset allocation models. Against this backdrop of rising prices, Fed Chair Kevin Warsh made a decisive move that shocked Wall Street. He appointed 2 new advisors to the central bank's inner circle, selecting individuals known for their hardline views. In Washington, personnel is policy, and these appointments represent a major hawkish shift in the central bank's stance. Both advisors have long track records of favoring aggressive rate hikes to combat persistent inflation pressures. They believe the Fed has been too slow to respond to the structural forces driving up prices. Their inclusion signals that the central bank is preparing to tighten policy further, regardless of the domestic political pressure. Wall Street immediately took notice, adjusting their portfolios in anticipation of higher yields and lower stock valuations. This is not a routine staff rotation. This is the formation of a war cabinet. The Fed is gearing up for a protracted battle against rising consumer prices that will affect everyone. How does a rate hike in Washington impact the rest of the world? When the Fed raises interest rates, it increases the return on risk-free U.S. Treasury bonds. Investors seeking safety and yield immediately pull capital out of riskier emerging markets. They convert their local currencies into U.S. dollars to buy these high-yield assets, draining global liquidity. This massive capital shift strengthens the greenback against almost every global currency, causing widespread pain. At the same time, it drives up borrowing costs worldwide, making it harder for companies to finance operations. Emerging markets that borrow in dollars suddenly find their debt burden skyrocketing, as they must pay back in stronger dollars. The global liquidity pool shrinks, leaving weaker economies highly exposed to sudden defaults and balance of payment crises. The Fed's domestic fight is exporting financial tightening to the global stage, forcing international cooperation to prevent collapses. The foreign exchange markets are the first line of impact in this monetary war. As the U.S. dollar strengthens, other currencies must depreciate, losing value against the greenback. Central banks face a painful dilemma: follow the Fed by raising rates, or let their currency collapse. Raising rates defends the currency but hurts local economic growth and increases unemployment. Letting the currency drop drives up import inflation, particularly for critical commodities like energy and food. This currency pressure is hitting Asia hardest, where trade is heavily dollarized and dependent on imports. The financial stability of major trading nations is being tested as capital flees to the West. Policymakers are running out of options to support their currencies, with interventions proving ineffective. A currency depreciation spiral has already begun across major Asian financial hubs, threatening trade balances and growth. Nowhere is this crisis more visible than in Japan, where the yen is near a 40-year low. The Bank of Japan is caught in a historic trap of its own making. Japan has a massive government debt load, exceeding 260% of its GDP. If the Bank of Japan raises interest rates to defend the yen, its interest service costs will explode, risking bankruptcy. But if it keeps rates near zero, the currency will continue its freefall, eroding household wealth. This weakens consumer purchasing power and increases the cost of imported fuel, which Japan relies on. Japan's economic model, built on cheap exports and foreign energy, is fracture-tested by this dollar strength. A stronger US dollar pushes the yen closer to the edge, forcing Tokyo to reconsider its decades-long monetary policy. The currency pressure radiates outward from Tokyo, directly affecting Southeast Asia. The Singapore dollar and the Indian currency are facing intense depreciation pressure. Singapore, as a global trade hub, relies heavily on a stable currency to keep import costs low. A weakening Singapore dollar immediately feeds into domestic inflation, raising costs for citizens and businesses. In India, a weaker rupee drives up the price of crude oil, which is priced exclusively in US dollars. This widens India's trade deficit and strains government finances, forcing fiscal adjustments. The entire Southeast Asian region is importing inflation from the United States. Local central banks are forced to burn through foreign reserves to defend their currencies, weakening their balance sheets and sovereign ratings. As the dollar rises, international investors are initiating a massive rotation of their capital. They are pulling money out of emerging market equities and bonds to seek safety. The promise of high-yield U.S. assets is simply too attractive to ignore, even for long-term investors. This capital flight starves Southeast Asian companies of foreign investment, slowing down expansion projects and hiring. Local stock markets in Jakarta, Kuala Lumpur, and Mumbai are experiencing sharp sell-offs. The cost of capital for Asian businesses is rising rapidly, choking economic growth. This slows down infrastructure development and technology investments, which are crucial for the region's development. We are seeing a classic capital drainage, where wealth flows back to the center of the financial system, leaving emerging economies to starve. This global shift is forcing a major repricing of risk assets around the world. Equities, real estate, and fixed income must adapt to the new reality of higher-for-longer rates. In the U.S., high-growth technology stocks are highly sensitive to rising borrowing costs, leading to valuation adjustments. In Asia, real estate developers are struggling to refinance their dollar-denominated debt, raising default risks. Homebuyers in Singapore and Hong Kong face higher mortgage rates, cooling down property markets and consumer spending. Exporters, who benefit from a weaker local currency, are the only bright spot in this environment. However, their gains are offset by the rising cost of imported raw materials and logistics. The entire asset landscape is shifting, creating winners and losers in every market of the region, requiring active management. A dangerous feedback loop is now developing between the U.S. and Asia. As Asian currencies weaken, they import inflation from the United States, raising consumer prices. This imported inflation forces Asian central banks to raise rates themselves to protect their exchange rates. They must do this even if their local economies are slowing down, risking a deeper recession. This creates a stagflationary environment, where growth stalls while prices continue to rise. Central banks are effectively losing control of their domestic monetary policy. Their decisions are being dictated by the Fed's actions, undermining their sovereignty. This feedback mechanism is the hidden cost of the dollar's global hegemony. It traps emerging markets in a cycle of defensive tightening, threatening long-term economic stability and social cohesion. This monetary pressure is accelerating a structural shift in global finance and trade. Tired of being at the mercy of the Fed, Asian nations are seeking alternatives. They are actively promoting local currency settlement agreements for regional trade, reducing dependence on the dollar. China, India, and ASEAN are building payment networks that bypass the US dollar entirely. The goal is to insulate their economies from Washington's interest rate cycles and policy shifts. This de-dollarization trend is no longer just political rhetoric. It is becoming a matter of economic survival in a highly volatile world. The Fed's aggressive policy is pushing its allies and adversaries to build a parallel financial system, changing the global trade balance. The lesson for APAC investors is clear: and undeniable. The global financial machine is deeply interconnected, meaning no market exists in isolation. A decision by two new Fed advisors in Washington has direct consequences for your portfolio in Singapore, Tokyo, or Mumbai. Investors must look beyond local headlines to understand the macro forces at play. In this new era of hawkish Fed policy, diversification and currency hedging are critical for survival. The dollar's strength will continue to pressure Asian assets, creating significant headwinds. Only those who connect the dots will survive the coming squeeze and find new opportunities. Thank you for watching East of Wall Street. Subscribe to stay ahead of the global shifts in power and money.